Here we go. Great. So today we're talking about a fresh line of stocks from Together Investing Club. We have lately covered companies that have been manufacturing units or service industries or IT companies, but for the first time we are trying to cover a banking and finance company, because a lot of members from the Together Investing Club requested on how to go ahead with the banking and finance, and this is probably one of the easiest banking and finance companies that there is. Why is it so? We'll just get to know about why exactly HDFC Asset Management Company Limited is one of the easiest companies in the banking and finance space or in the FIBA space to go ahead and analyze in terms of a value or a growth investor or a strategic investor, and to see of how exactly can we analyze this business model and to know more about asset management in India and globally. So going ahead, I have with me. Okay, so going ahead, I have with me amazing colleague of mine, Deven Sharma. So Deven Sharma is a finance graduate from Amity University, Noida. He has almost 1.5 years of experience in portfolio management and research with me, and of course, otherwise as well. He's currently working as a research analyst at A3D Capital LLP. Additionally, he's a CFA level 1 candidate and has worked at Nikon Stockbrokers Limited as a summer intern. And that's Deven's email ID. If you ever want to post any query or if you want to post anything, please ping him directly. Deven, over to you.
So today we'll be discussing about HDFC as a brand and also their AMC subsidiary. And we'll be discussing about their business model. Then we'll be talking about their competitive advantage in the market. So going further in the presentation, Emmanuel sir, to the next slide, please.
Sure. I guess you're forgetting to introduce me.
You really don't need any kind of introduction.
Okay.
So anyway, so Emmanuel sir introduced me, and Emmanuel Suraj sir has been my mentor when I worked at Nikon Stockbroker. He was my mentor, so he introduced me to the world of investment. I had a lot of concepts which were wrong, and he reintroduced the investment world. So he was my senior in Amity University, and he's also a gold medalist in his class. And when he was in Amity University, he went to Clapton University as well, and over there he did his finance as his major. He has also trained in ICICI Direct, IIM Ahmedabad, IIM Kanpur and Moody's on various fronts, along with his pursuit of Indian financial markets. He has also worked in big houses like Fidelity, Barclays, and Allianz within the USA, and he has also been associated with Moody's. So over there, we have his email address, and we can always ping him, and we all know his mobile number. Over to you, sir.
Thank you, Deven. Well, guys, going ahead, let's first understand the business model for, when we, like Warren Buffett says, if you don't understand the business model, do not put your money in a company. And the same goes for all us as retail investors or all us as investors. So let's go ahead and understand what exactly is asset management company. Let's forget the name of the company and let's just say what is an asset management company basically. So first things first, an asset management company is like a team of experts who are going ahead and managing your money in the markets. It can be equity markets, it can be debt markets, it can be hybrid, it can be any asset class. The simple agenda is that because we are not well-versed as investors, or because there is someone in the society who doesn't know how to invest, they hand over the money to a management company, and these are professionals who manage the capital that is being allocated by individuals in the market, also institutions. So for example, let's consider an asset management company called, let's say, A. So asset under management for company A is, let's say, 1 lakh crore rupees, right? So out of that, I'm on an average considering 0.75 as fund management charge, right? So on an average, the fund management charges vary from 0.5 to 1.5, and they keep going on depending on what kind of fund it is. On an average, I'm taking an India flat rate of 0.75. So the revenue on a 1 lakh crore would be 750 crores. Then the operating income is somewhere around 525 crores. This is a rational industry protocol that we've taken on the same. So out of the revenue, we're talking about all the expenses, for example, employee expenses, all the other expenses that come in, and we're talking about 525 crores in the company A. Operating cash flow of around 262 crores. Capital expenditure should be as minimum as possible because it's a service industry, around 20 crores, and then free cash flow of around 242 crores out of the 750 crores of revenue that was generated from the fund management charge. So what exactly I'm talking here is simply that asset management company is as good as an IT company. So HDFC AMC is as good as Infosys or as good as TCS, because all they're doing is charging a fees for the expertise that they're providing, right? So it is a banking and finance placed in company, but it is not a typical banking and finance company where the cash flow statements are all negative and we're looking at deposits and reinvestment of capital to a certain level. So this is a normal business. It lies under the banking and finance, but it's a normal business where a company is using its fiduciary relationship, a company is using its tech, a company is using its expertise in managing capital in the asset space or in the financial ecosystem and charging for that particular experience. So it's as good as any service industry that there is. So what are the focus areas in this business model? The focus area is more the asset under management, larger are the sources or larger is the potential for revenue, right? So the more AUM you have, the larger your chances of earning more money can be. The second is fund management charges that you have to focus on. If the fund management charges keep going down like they have been in the recent past, Aditya here is from A3D and he's an expert with mutual funds. But if the fund management charges keep sliding down like they have been in the recent past, the margins for an asset management company keep going down. So we have to focus on total asset under management. We have to focus on the fund management charge. That is the charge the asset management company allocates or takes from the investors or from people who have handed the capital. Then we're talking about operating margins. So we should not be paying too much in terms of salaries, or there should not be a bleeder in the company. The operating margin should be intact. We are talking about an intact operating margin, and there should be a sufficient free cash flow because this is not a capital intensive business. It's a capital free business mostly. And the idea simply is the free cash flow should be significant if you're talking about an asset management company as a business model for shareholders respect, or companies that are about to respect shareholders' capital. If I go ahead further, what we're looking at is a global AUM. So we'll be first talking about the business in terms of global economics of how exactly globally is asset under management position. And then we'll be sliding down to India. And then further, we'll be focusing on the particular company that we're talking about. So this is a PwC analysis. It was submitted this year in 2020 in the early first quarter. So global asset under management by region in US dollars or US trillion dollars. So 2004 to 2025 estimate, in which 2020 is also considered as an estimate. So what we're looking at is a significant rise year on year. From 2007 to 12, we're not looking at major rise because we saw 2008 in between. But what we are actually seeing is that there is a significant rise in total AUM, that is a total asset under management globally. And if we look at area specific or geography specific, we're looking at Asia Pacific as the largest riser whatsoever in the other or amidst other areas that there is, right? And also North America is one of the finest markets that there is. There is a lot of global capital that has also been attracted by Asia and North America. So these are the two capitals that we'll be looking at, very, very fragile, very, very prudently. But the idea simply is that the graph keeps going up. And even if we had another estimate of 2030, for example, it would have still gone higher, because the more money printed, the more money earned, the more money circulated, probably the more money invested too. When I go to the next slide, what I'm talking about is alternatives to asset under management, or alternatives to mutual fund industry, or alternatives to professional management, right? So we're talking about hedge funds, infrastructure, real estate, commodities, private equity, and all these kind of things. If you see, if you compare both the charts, we're still looking at a huge gap between professional asset under management, or between professional mutual fund houses and unprofessional, or or long short strategies, or other alternate sources of investments like infrastructure, real estate, and commodities. So the idea is, yes, gold is probably just created its lifetime high, but you're not seeing huge inflows into commodities, or you're not seeing huge inflows into those categories. It would still remain the financial service. It would still remain the financial securities as the to-go instrument when we're talking about global investments or about retail and institutional and individual investments. Now we come down to India. This is AMFI's website as of date. It says Indian mutual fund industry's average asset under management is at 27.28 lakh crores. So from US dollars, now we're shifting to Indian rupees. So 27.28 lakh crores is, or 27.28 trillion rupees is the total asset under management for India. Now, for a lot of us who are from the club, or, we understand, we know that India's GDP today stands at $2.8 trillion, right? And the market cap stands at $2.1 trillion. So this is not even 11% of India's GDP. So there is a huge gap between how this has to be done. And when we're talking about US, where the GDP, AUM to GDP gap is not even, it's par. Almost 100% of GDP is their asset under management. So when we're talking about 11% and 100% in US, or any other country, if we talk about South Korea, where 76%, or if we talk about any good country that is financially mature, we're talking about the gap being too wide in India. So this gap will get filled. And what we're looking at is, this particular 27.28 trillion rupees that India holds as asset under management, or Indian AMCs hold as asset under management, are going to surge, not because we're looking at growth in the economy's point of view, but we're looking at the gap getting filled, or the disbalance between investments and GDP getting filled very quickly. Growth, of course, is a different factor, but the major factor we're considering is penetration. Now, if I go ahead, I see that 135.26 crores is India's total population. 105 crore people have bank accounts in India, but only 2 crore people invest through mutual funds. So even if I'm saying 10% of my total population starts investing in the economy, or even if I'm saying 20-25%, that's a huge surge in total per capita, or that's a huge surge in per capita investments in mutual funds that I'm talking about. So we're not even considering growth factor here. All we're saying is the existing population, if that migrates from fixed deposits, from gold to cash reserves, if it migrates to financial securities, mutual fund is the best place they can park. Because if we understand the Indian structure, we have a product called alternate investment fund, right? It's almost like a hedge fund. It's called an AIF in India. So if we talk about AIF, SEBI strictly prohibits any investment less than 1 crore rupees to enter the AIF, right? The second best, or the second product, or the second step is a PMS, where PMS is portfolio management services. You will see a lot of good PMSs around. Motilal, SBI, all these companies have PMSs. The idea is PMS, again, SEBI restricts no money less than 50 lakh rupees can enter and stay in PMS. Right? So the idea is, if I'm an investor and I'm not able to invest 50 lakh rupees as a chunk, the only platform left for me is mutual funds, or I have to go ahead, a professional management left for me is mutual funds, right? So that is what we're looking at. There is a huge gap in the market. And if this gap starts getting filled, we're looking at huge revenues for all the companies or all the players that are there in the market. Now, if I go ahead, these are the SIP contributions in crores that come up in India. I'm so sorry. SIP crores that come up in India. So 2016-17, we were talking about 43,921 crores, and total SIPs that are collected in India. And as of 19-20, we're talking about 1 lakh crores. So there is a huge, almost 2 times. But we will have to understand that this is every annum. This addition is every annum. So there was a statement made by Mahindra's AUM asset under AMC chairman. They said that mutual fund industry AUM to hit rupees 100 trillion by 2025, and we're talking about India in capital here. So the idea is that we are not talking about how exactly are we going to gain new, or how exactly is the industry dynamics going to change, or how we're talking about growth. We're simply talking about good penetration by the product. which we are already seeing. The tier 2, tier 3 cities are heavily targeted by banking institutions specifically. And there is a huge network base that is being built of mutual fund distributors and mutual fund promoters in the ecosystem, that we are looking at this gap to get filled as soon as it can be. Over to Deven for his part.
So now we have basically talked about what the industry is, how the economy looks when it comes to investment or AUM. Now, when we have to invest in it, we will have to finalize on one stock, and we would obviously try to pick the best one. So we have always talked about that HDFC is a big giant, and they have their individual subsidiaries, and we are now going to talk about what the competitive position of each subsidiary is. So this is a flow chart that I've created. And over here, we can see that we are all familiar with these logos. And when we talk about HDFC Ergo, so it is among the top three players when it comes to general insurance. When it comes to HDFC Mutual Fund, that is HDFC AMC, we are going to talk about in the further slide what their competitive advantage or what their market share is like. And I can say that it is among the top three in their segment. When it comes to HDFC Life, they rank the first. They have the undisputed crowd or in that industry. They are the leaders in that. And when we talk about HDFC Bank, and we know there's a battle going on, okay, which one is better when it comes to private bank, HDFC or ICICI, and a lot of players prefer HDFC Bank. And over here we have HDFC Credila, so that is for education loans. So in India, whenever anyone wants to have a loan for their education, the first preference that they go for is HDFC Credila, because of the facility or maybe the less documentation work that HDFC Credila engages into. And we'll be talking about in the further slide what the business model of HDFC AMC is. So when we talk about schemes, so they have 23 equity schemes, 90 debt schemes, 2 liquid schemes, and there are other 7 schemes which are uncategorized. And when it comes to performance, so this is the latest data that we pulled out from their annual general report. So they have over 3 lakh crore of AUM under their belt. And they also have a huge distribution channel. They have a lot of partners. In 2016, they had a partner network of 55,000, and they are building upon it. And in March 2020, as per the recent data, they crossed the level of 70,000 plus distribution partners. And over here, the graph we can see over here is their growth. So from March 16, they had 1,65,000 lakh of crore of AUM under their belt, and they have grown significantly. From March 19 to 20, they saw a little bit of dip, but when we talk about CAGR, that is cumulative annual growth rate, we can see from 2015 to 2020, they have seen an upside of 25% in their AUM under the belt. And they have rupees 94 billion under their PMS and AUM, and they have a wide network, 221 branches and 65 distribution partners, 65,000 distribution partners. So in the next slide, we'll be talking about the peer performance. So what I've done over here is I've taken 3 entities for comparison of performance. One is HDFC AMC, another one is Nifty 50, that is our benchmark, and third one is Nippon. So I have rebased the price chart to the value of 100, that is the base value now, and we have tried to analyze their relative performance when the base value is 100. So we can see when it comes to the blue line represents HDFC AMC. So we are able to see that HDFC AMC has been able to outperform Nifty as well as Nippon. And this is the data from 2018 because HDFC AMC had their IPO in August 2018. So that's the time frame that I've chosen of 2 years. So going further, so this is the chart for the market share HDFC AMC enjoys. So over here, we can see top 10 AMC account for 84% of AUM volume in India. And when it comes to individual market share, SBI is at the top at 14.9%. And the second is HDFC AMC that we are discussing right now. But the thing is, the listed competitor that they have is Nippon. And when we talk about Nippon, that has only 6.9% of market share. So if you want to enter into this industry, if we see a growth in this industry, HDFC AMC can be our best bet. And we'll be talking about the market penetration India has seen in the next slide. So this is the data that we have pulled from AMC, and we can see that mutual fund AUM as a percentage of GDP in India, uh, it is not that penetrated. The market has huge potential that can be tapped, and we are observing some kind of growth. But the thing is, the penetration is still at the lower levels. When we compare it to the developed countries, countries like USA, Brazil, France, so we can see in USA it is at 103 percentage of the GDP, and India is only 11%. So we can see that this industry has a huge potential or upside to grow. And the factor driving increase in penetration is improving financial literacy. As the new generation are coming, they are trying to explore the world of investment. They are trying to engage into investments from very early age, and so the AUM is increasing by every year as we go by. And rising middle class income, so people are having their incomes, and they are becoming a bit matured and bit literate in financial literacy, so they are parking some of their fund, like we have discussed in the past presentation. People are engaging into investment. They are becoming more aware about emergency fund, or they are becoming more aware about investment or retirement planning, so they are parking their funds in investment. So in the next slide, we'll be talking about the shareholding pattern. So shareholding pattern of HDFC is HDFC AMC is pretty tight. So they have been able to keep us above 70% of shareholding percentage of promoters in the whole company. And as SEBI's guidelines, a company can have up to 75% of shareholding when a company is listed. So they are intact at 74%. And mutual funds houses are also interested highly in this stock, and they are increasing their percentage of holdings in the company every year, as we can see from the data. And FIA are also interested. So we all know that FIA are the big research players when it comes to investing in a company, and they have a huge confidence in HDFC AMC. So this can be a good parameter to us because there are bigger players who have a large confidence in the company. So we as retail investor can rest assured that the company is going to do well, or the company is fundamentally good. So now we are going to talk about the valuation, and that would be covered by Emmanuel.
Thank you, Deven. So the idea here simply is that we're looking at the gap getting filled, where globally we're looking at 62% as GDP, AUM to GDP, and India we're looking at 11%. So the idea simply is, even if this gap gets filled, we're looking at huge revenues in terms of the positioning here. And like Deven already mentioned, if like we used to talk about market cap to GDP, and we would say that, you know, if a sector has high contribution in GDP but has a low market cap, there is highly likely chances that the market cap would catch up. So the GDP contribution is always caught up by the market cap. In the same way, if this particular industry is going to be a good industry, or it's going to contribute in the GDP, or, you know, it's actually going to fill up the gap that it existingly is, the market cap will have to catch up. The market cap will have to come around it, and the penetration will have to come around it. So now quickly going and talking about the valuations. This is the cash flow statement for HDFC AMC, and we're talking about all these financials here. So for those of us who are not currently aware, or we're not currently savvy of this particular structure, I would quickly go to the ratios. So today, as of date, Google Finance says that the price of HDFC AMC is 2,396 rupees and 60 paisa. So debt to equity, of course, it's zero. It's a debt-free company, and I would be really surprised if an AMC comes up with a debt ever in its sheets. It would highly be surprising for me. Mostly, these companies should be debt-free. If you ever see an AMC with a debt, please red flag it. There is no use of debt whatsoever in this particular business model, because the debt is zero. Interest coverage ratio stands irrelevant, but they've just quoted a number, but it's actually irrelevant because the debt to equity is zero. We're talking about a significant return on equity of 38.66%, and as the club members would already know, 15% according to the currency value chain is considered amazingly well, or is considered acceptable, but 38.66% is more than acceptable. It's very good. Gross profit margins, if I go ahead and plot the gross profit margins, you will see that there is a significant surge in gross profit margins year on year. And we're looking at, so there is a significant surge in gross profit margins year on year, and we're looking at huge increase, or from 69.5% to 88% is huge profits. I mean, I have not seen any statement where 88% is a gross profit margin in India apart from this particular company. And if you look at operating profit margins, also they're in sync with the GPM or the gross profit margins. We're looking from 55.7% a raise to 75.6%. So the OPM and GPM are perfect here. Price to earnings is one point of concern. We're looking at huge sentiments in the company, and we're looking at probably less rationality as of now. But that is where we're going to see whether it will fall under a value investing strategy or the growth investing strategy. Price to earning growth is perfectly all right. Price to book value here would not make any sense, so we will just skip that part as of now. So yeah. Now we're talking about capacity spending. So it's around 2.32%. Again, as it's a service industry, we do not need so much of capital whatsoever. So around 2.32% of operating cash is what we're looking at capacity spending. The free cash flow average for the 10 years is around 6,792 million rupees. The intrinsic value stands at somewhere around 3,97,000. But intrinsic value per share is around 1,866 rupees and 23 paise. So we're looking at a valuation gap of 28.42%, almost 30% when we're talking about the current market price and when we're talking about the intrinsic value of the company. So the idea simply is it's not a value stock for sure. We're looking at growth strategy now. We will be looking at growth strategy here. So the idea is if it's not value investing, but if all the qualitative parameters are acceptable and we're looking at a huge return on equity, we would not want to miss the bus where the stock probably skyrockets from here and we're just sitting ducks because we wanted to invest in value. So if it's not value investing, let's go ahead and see if it's a growth stock. So when I go ahead and turn to ROE, PE, and so when I go ahead and turn down to a formulation where we talk about when exactly will it become a value investing if I start deducting the price to earnings or the price that I've invested in the stock, we're looking at a 7th year break even, a 6.5 year break even most likely, which is 1 year above our acceptance, but it probably is it's acceptable. So I can go ahead and say that someone who would like to take exposure in this particular industry should go ahead right now. If you're about to calculate the fundamental growth in the stock, considering all factors consistent, we're talking about 50 stocks of HDFC bought at 2,396 rupees, surging to 8,623 rupees, and the valuation swelling, or the price, the total allocation going from 1,19,000 to 4,31,000. So this is a fundamental structure. These are all based on assumptions that the ROE, the return on equity, the price to earnings, and earning per share would keep graduating on the same levels that we've taken from the statements, from the cash flow statements of the company. So the idea remaining, if we're looking at taking exposure in this particular sector, as already we're not taking only because we have no other option, because no other company is listed, but also because this company falls under a good growth company, or we are talking about a good growth strategy here. So that's the value, that's the valuation part of it. Back to you, Deven.
So now that we have discussed what the business model or what competitive position of this company holds, and we have also talked about the valuation, we know that this is not one of the value investing stock, but it is one of the growth stocks. And we have also talked about by what year we can have a break even. So now the question is, when should we enter this stock? When should we buy this stock? Because we all know we book profit when we buy. So in the next slide, we'll be observing the technical chart. And so the stock is currently into its resistance channel. So what we would recommend is that we would wait for this stock to break this channel. And when we talk about our buying strategy, so when it comes to this yellow line that we can see, which has a price depicted 25.30. So it is very important that a candle should break this line first. And if you want to, if you can take some sort of risk, you can buy at this point after the breakout of this line. And if you want to be safe, if you really can't face any risk, you don't want to face any risk. So what I would suggest is you should wait till it breaks the price level of 27.93. So that's the second yellow line. So currently, as I said, the stock is into resistance channel, and we would wait for this stock to break these resistance first, and then we can enter the stock.
Thank you, Deven. Also, guys, as we can see that the stock is currently less volatile, and we're seeing that the volatility of the stock is quite less. So we would not recommend anyone as a trader to go ahead and explore the stock. The idea is we should remain or we should keep looking at this stock as an investment point of view. Only trading in this stock might not give you the volatility required for you to go ahead and book profits when you're actually looking at the trader's perspective. That's Deven and Emmanuel for today, guys, and we are open for questions and answers. Please unmute yourself and ask questions, or you can also type them on the chat box. Aditya, I would request you to keep an eye on the chat box if someone just puts in a question. For the rest of us who can, please unmute yourself and go ahead and ask us questions. We are open for questions. Also, we are open to feedbacks, and we are open to anyone who would want to suggest a stock or who would want to suggest a strategy or a sector for the next presentation that we would you would want us to come up with in the meanwhile, and we're open to questions again.
Yeah, I had a question. Deven, if we enter at a 2530 level, then would the current levels of 2399 act as a stop loss?
So can we open the chart? Yeah.
Yeah, I was asking if we enter at the 2530 levels, can we keep a stop loss at a 2399? Like, consider it to be a support.
So the stop loss can be your previous candle, the closing of previous candle. That can be your stop loss once it breaks out this yellow line.
Okay, thank you. Understood.
So, Gagan, what Deven is trying to say is you can use a trailing stop loss, but for the first purchase, you'll have to wait for the closing of the candle to be about 2530. So enter only if the closing of a candle is about 2530 and the next candle's open is equal to or higher than the closing of the candle that has closed about 2530. First point. The second is the stop loss can be kept at around 2500 if you're a very safe player like me. If you're not, then you can have a stop loss at 2399 as a level also. But the recommended would be to make sure that the stop loss is not that your stop loss triggers as soon as it enters the flag again. If the channel that we have drawn here, if it enters the channel again, just make sure you're exiting it. But 2530 closing above this and next day's opening higher than last day's closing, both the conditions should be fulfilled here. Gagan, I hope that answers your question.
Yeah, it does. Thanks.
Thank you so much. Guys, we are open to any other questions that you might have, or any recommendations or any suggestions for our future presentations, please.
Yeah, Emmanuel sir.
Yes, sir.
IPO के टाइम का मेरे पास ये स्टॉक में इन्वेस्टेड हूँ मैं, अराउंड 1100 पे था ये जब ये ओपन हुआ था. तो मेरे पास ये स्टॉक उसी टाइम से है. इस टाइम पे इसे एवरेज करना चाहिए, इसमें और एड ऑन कर देना चाहिए इसी टाइम, जैसे अब मैं समझ पा रहा हूँ, बट ये एज इन जो ऑलरेडी इन्वेस्टेड है उस हिसाब से मैं पूछ रहा हूँ.
ओके,
ब्रेक इवन.
हाँ सुमित सर, द आइडिया सिंपली इज आपको पहले ये बताना पड़ेगा कि आपके पोर्टफोलियो का कितना परसेंट अभी है HDFC AMC. तो फॉर एग्जांपल अगर अभी आपके पोर्टफोलियो में या आपके इन्वेस्टमेंट कॉर्पस में 100 रुपए हैं, तो अभी कितना परसेंट HDFC AMC है?
5%.
5%. तो सर और ऐड मत कीजिएगा. If your current holding is less than 3% in HDFC AMC, only then you can go ahead and add new, because in a growth strategy, we do not recommend you park more than 3% in a growth stock. If it was value, I could have said 3 to 5 is okay. But if you've already bought 5% at IPO levels, please do not add more, because the idea is then the risk that you're taking or your Sharpe ratio would get, it will get out of the sequence. So if you already have 5%, please don't add more.
Because IPO के टाइम 13 आए थे, उसके बाद मैंने फिर एवरेज किया था इसको अराउंड 14-15 के बीच में.
Okay. Great, sir. Please stick to that position. Please do not buy more.
Emmanuel, sir. Yeah, I have a question. Is there a downtrend in the stock, or if we see the technical, if we see the charts, and how is this stock volatility compared to the Nifty volatility? So how can how's this stock volatility compared to the Nifty one, and is there downtrend in the stock or not? I can see in the charts.
So as of now, there is a downtrend. Anubhav, you're right. Okay. Am I audible?
Yes, sir.
Okay.
Yeah.
So as of now, there is downtrend. If you're talking about volatility of HDFC AMC in comparison to Nifty, we will have to calculate the beta of the stock, right? So if I see the beta of the stock on a daily, if I talk about beta, it's somewhere around 1.07. It was earlier, but right now it is about 0.157 or 0.56 ke beech mein hai. So the idea is it's not as volatile as Nifty. So if you are a trader, trading Nifty would give you more swing, both on upside and downside. But if you're an investor, then beta doesn't actually affect you. मतलब मुझे फर्क नहीं पड़ता कि निफ्टी के अगेंस्ट मेरा स्टॉक कितना ऊपर नीचे जाएगा if I'm an investor. But if I'm a trader, I would want to know what's the beta. So as of now, the beta is somewhere around 0.15 and 0.5, depending on what time frame are you taking and what daily duration or weekly duration. But generally the beta is low. It's a low beta stock.
So as we can see that it is at its support price 2399. So why won't we right now? Why can't we buy it right now and wait it for to go its next resistance?
Anubhav, it is not at support right now because the recent price has already breached the support. It has already tested the support. That is why you will see in the presentation we have not drawn a support line.
Okay, sir.
It would have been at support if the recent view that you see in the chart. If I can just show you. So is the screen visible? I hope it is.
Yes, sir.
If this U would have not formed, where we would have not challenged the support that you're talking about, then we would have considered it around support. But because the recent price has already tested the previous support, we're not considering it as a support right now. So that is why we are saying let it break the recent high, the lower high, then it makes sense to enter.
Okay, sir. Thank you, sir. Thank you.
And Anubhav, do not buy it for short term.
Okay.
Right? It's a long term. It's a long race. It's a very amazing horse to ride on. Do not buy it for short term. I'm telling it to you specifically because that question somehow tells me that you're looking at buying it and then selling it away. Do not sell it. If you've bought it, don't sell it. Right?
Okay. Thank you.
So Deepak has a question in the chat box. He's written how can all this knowledge help someone who has just graduated as an economics graduate? Well, I mean, I loved economics when I was in college, but trust me, it really is very difficult to apply all the economics that we learn into the financial world or in the real world. Hence, we need finance. Also, how this all is, I don't know. It's up to you on where you want to use it and how you want to use it. We use it for wealth maximization and wealth generation for ourselves and for everyone around us. It's up to you on how you would like to use it. Great. So do we have any other questions, guys?
Yes, I have, sir.
Please go ahead.
Yeah. So in my portfolio, HDFC consists of 36%. Like I have 36% hold of HDFC and HDFC Bank. So should I lose something from HDFC or HDFC Bank and invest in HDFC AMC for around 2-3 years of if I'm looking for?
Labansh, I'll talk about 5 years minimum. Okay. Let's talk about 5 years minimum. So let's say you have 100 rupees of HDFC as of now, or you have 100% of HDFC as of now, right? And when I say HDFC, I'm saying HDFC and HDFC Bank both. Okay. So I would suggest that 15% of that can be shredded from the market and allocated to AMC. I'll tell you why. This is a more aggressive business than bank or housing finance, right?
Okay.
As of now, you will not see HDFC Bank giving return on equity of around 40%. And we can never see HDFC, the parent company, giving return on equity of about 40%. But also, when you're shredding HDFC and moving to HDFC AMC, the problem is you're attracting more risk, because AMC as of now is not that a fancy business in India, right? Cash cows still would be banking, and cash cows still are housing and banking, housing finance. So when you're shredding it away, there are two questions that you will have to ask yourself. The first is, how long can you hold this entire new restructured portfolio that you're building, right? If your answer to that is more than 5 years, more than 10 years, go ahead and shred at least 20 to 15% of HDFC and HDFC Bank, and please park it with HDFC AMC. I did the same when ICICI Lombard came as an IPO. I shredded almost 20% of my ICICI Bank's holding, and I parked it with ICICI Lombard. And today, if I see my portfolio, ICICI Bank is still at the same position, and Lombard is giving me somewhere around 80% returns on actual basis. But when I see my entire portfolio, because I have made a portfolio of base and aggressive stocks, my entire portfolio somewhere is at par when I'm comparing it with index. So you're very good, you're very wise in asking that question. But when you're doing that, please do not do more than 20% of shredding in the existing position. Only 20 to 15% is probably advisable or permissible to be allocated with HDFC AMC.
And that too after it breaks 2530.
That too after it breaks 2530 on closing basis on a daily chart.
Yeah, sure. Thank you.
Right. Also, Levansh, tomorrow if we come up with a new IPO of, let's say, HDFC Cards, or let's say we come up with any new IPO in the HDFC entire umbrella that Deven just discussed, do the same. But keep your percentages intact with the return on equity these companies are giving, or keep your percentages intact with how aggressive these companies are. So if a company is less aggressive, the shredding should be smaller. If the company is little more aggressive, the shredding should be a little deep. Because at the end of the day, you know, when it was all one company, all these revenues were going into the mainstream and you were getting exposure in the parent company. But as and when these companies get listed, you will not get exposure in good businesses. So you need exposure in aggressive businesses also. And because they're all from the same parent or they're all under the same umbrella, you can expect very good corporate governance. So if you're already an investor in HDFC Bank, you don't have to do the qualitative analysis all over again. You only have to stick with numbers.
Sure. Thank you.
Thank you so much.
So I have a question. Yesterday, as we were discussing, that if the parameters are not met and if we reach the break even after 5 years, we take it as a speculative stock instead of a growth stock. So you are categorizing this as a growth or a speculative one?
This is a growth stock because I'm taking an exception of 6 months here.
Okay.
Because it is only short of 6 months when we're talking about that particular theory. And that might not be relevant to everyone. So I'll take it offline with you. But the idea is this is a growth stock. This is not a speculative. Otherwise, I would have not recommended 3% to 5% allocation. In speculation, we only go ahead and do 1% of the allocation.
Okay, so thank you.
Thank you. So we have a question from RT. I don't know who that is. The name is not clear. From RT. If you're considering it for a long term, how would you plan the exit? Based on any significant change in the fundamentals or by keeping trailing stop loss on a higher time frame chart, say weekly or monthly? Well, sir, if you ask me, I would take an exit on trailing stop loss, of course. But I would recommend for those of us who do not know how to use a trailing stop loss, to consider, at least 3 weeks of candles. If the 3 weeks of candles are in red, or, I personally say that fundamentals would come later and technicals come early. So on technicals, you will see any change a little more earlier than you will see on the cash flow statement or in the balance sheet. So the answer to that question is please always use trailing stop loss. And you're very wise to ask if on a weekly or a monthly chart. Please go ahead and do it on the weekly chart. And you can use different strategies for trailing stop loss. There are many strategies on trailing stop loss. You can use any one of them. Because once trailing stop loss is triggered and fundamentals have not changed, but still the price is falling down, you can buy at a better valuation. And if the trading stop loss is triggered and the earnings have also fallen, you can go ahead and lose the position quicker as compared to waiting for the quarterly earnings to be reported by the company and then knowing that the earnings are not significant enough for an investor to keep holding. So please use trading stop loss. It is better than using fundamental analysis, especially when you want to exit a stock. Thank you, sir. Great, guys. Any other questions, any suggestions, any stocks, any sectors that you would want us to do? We are coming up with a whole line of banking. We'll be doing a lot of banking for you guys because a lot of you have requested earlier. But any other suggestions, any questions, please go ahead and feel free to ask. Great. Also, if anyone would like to give us a feedback on how today's presentation was and was it worth a Sunday evening for you guys? So anyone who would like to tell us if there is any scope where we could improve or is there anything we could add? And if you like today's presentation, you're more than welcome to please unmute yourself and let us know.
Amazing presentation, sir, both by you and Deven.
Thank you. Thank you, Pranav. Thank you so much, sir.
Excellent presentation, sir. Amitabh, we really liked it and held AMC for some time, had bailed out and had rebought 5 days back, sir.
Thank you, Amitabh.
Excellent presentation, sir.
Thank you, Chirag. Thank you. And guys, our agenda simply is to make sure that we're going ahead in the right direction as a community of investors. Krishan, sir,
I love the presentation and I loved it.
Oh, thank you so much. You would want to have the presentation? Is that what you said, sir? Okay. I guess. Okay, guys, that's it from me and Deven. As there are no more questions from your end, last information, we have our 5th club. So we are 65 plus members in the Together Investing Club as of now. And we're looking forward to inviting 15 more members in our family on 30th of August. If you're interested in learning how we do all this and how we can go down and, try to understand the market dynamics, please connect with Deven, Aditya, and anyone who has invited you for today's presentation. It was an invite only. It was not for everyone. Please come ahead and, talk to us about your reservations, about how we could help you in the stock markets. Also, if you have any doubts regarding any stock, please connect with us and we'll be more than happy to help. Thank you so much. That's our Sunday evening. That's our portion of the Sunday evening. Please go ahead and enjoy the rest of your weekend and have a great week ahead. Thank you so much. Take care, everyone.